Hey guys, welcome to this week's Money and Investing Show. This week we are discussing, has inflation peaked? Tale of two stories here and in the US, as you're about to hear. Make sure you take plenty of notes and most importantly, take plenty of action. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Laurential.
Thank you for having me on the show, Mr. Baxter. Fresh outfit, fresh haircut, I can see there. Looking good today.
Looking sharp.
Good stuff. Well, speaking of hitting your peak, which by the looks of it, you are certainly now in your older age, we're going to talk about whether or not we're at peak inflation. Very timely conversation. We've just had new data come out in the US and a good follow-up from our conversation that we had back in May, episode 22, I think it is, where we spoke about this exactly.
Okay, so I think if I recall back in May, we asked the question, are we at peak inflation? And the answer was an outright no.
Absolutely no.
And here we are at the time of recording, at least in November, that maybe we are starting to see that, at least in the US. I don't think we are in Australia. So last week we saw the US Consumer Price Index, CPI, as it's referred to, come in at 7.7%, which is massively outside the bounds and boundaries that are set for the inflationary target, but not as high as previous months, and certainly a little less than expectations, which came as probably no surprise given how aggressive the US Federal Reserve have been in terms of raising interest rates.
And I think what's important for our listeners to understand, just because we're seeing a lower inflation reading does not mean prices are going down. That is not deflation. We're just seeing them increase less quickly.
Look, the party, inflation's over, it's starting to fall. And don't get me wrong, that's a good outcome. Don't expect a lower cost of living on the back of it, because prices very, very rarely come down. And I actually had a fairly spirited conversation with somebody on social media over the weekend about that. When we're talking about the strategy for inflation, they're going, well, inflation's finished, it's dropping now. And that's just simply not the case. With inflation at 7.7% in the US, that's going to take a couple of years to work itself out of the system, number one.
Well, targets, what about 2 to 3%? Is that correct?
2 to 3% is a healthy level of inflation. You need to have inflation because it is indicative of a growing economy. It puts some onus on people to spend money because it will be more expensive if you don't next year, versus deflation, where you don't need to spend money because it will be cheaper next year, which is a really dangerous roundabout to kind of get on. So the conversation I had with the person was, look, just because prices are falling, inflation is falling, prices won't fall. And they said, well, they will if there's no inflation is dropping. It's no. Inflation is the rate of change up in the price of an asset. And if the rate of change of prices moving up is slowing, that doesn't mean to say the thing is getting cheaper. And it was tantamount to, you got to work on Monday and say to your boss, okay, well, I see inflation figures are coming down. They go, yeah, so we're giving you a pay cut. That doesn't happen.
Definitely not. Well, I hope not.
So might be an idea actually. I might try that. It's certainly there to stay. But the US have been pretty aggressive in terms of their 0.75%, 75 basis point raises in rates, 4 of them in a row, which is again unprecedented. And that sort of sledgehammer approach has maybe seen us see a peak in US inflation. But that's not necessarily the same everywhere. And some of the reasons for the US and perhaps why it may be peaking, number one, obviously their central bank has been significantly more competent than ours when it comes to managing the inflation issue. But number two, the US dollar has also appreciated quite substantially, and as a result, the US hasn't been importing inflation from other countries. What I mean by imported inflation, it doesn't sort of arrive by FedEx. If you buy goods and services from overseas, and the cost of producing them has moved up, and you've got a relatively weak currency, what you're doing is importing more expensive goods and having to pay more based on the currency conversion rate. So you're getting kind of a double whammy. And that's actually a factor that's hit the UK quite hard, because the UK imports a great deal of material because it runs quite a substantial trade deficit. And also largely as a consequence of the failed economic policies of the shortest serving Prime Minister, Liz Truss, the pound has sort of got trounced, I think, in the currency markets, meaning that the UK is now not only dealing with inflation, but it's also importing inflation from pretty much most other countries around the world.
So we think about us here in Australia, AB, our inflation figure most recently, 7.3%.
Yeah.
And expected to go higher.
I think it's got more to go here for sure on a number of metrics. Number one, our central bank is really pussyfooted around in terms of its response. Well, number one, there was just, and look, go back through our podcast, I want to sound like a broken record, but I guess, we've been right on this and we continue to be right in terms of how we're calling it. Philip Lowe has been a disgrace as a central bank governor. The denial that there was any need to move interest rates up until until 2024, of course, was the initial statement. And the reason that's such a negligent statement to put out there is it's given many people a false hope and window for borrowing where they feel that they're safe to borrow decent quantities of money to get into the property market, for example. And okay, yes, buyer beware, you've got to be responsible for your own decisions. But when you get guidance from the central bank governor and it's just manifestly not correct, people base a lot of decisions on that. And then the notion, oh, we'll just got a quarter point here and a little slither there and we'll slow it down because we don't want to push ourselves into a recession. The reality, and I say this as an economist, I'm obviously not a central bank governor, but as an economist, I think you'd much rather be dealing with a recession than inflation, because it's much easier to kickstart a country that's in a recession than it is dealing with inflation. It's very hard to rein in.
And just to stop you there, AB, do you think that's where we're at the moment, whereby rates go up, we force a recession, or rates don't go up as quickly and we have sustained inflation?
Yeah, well, they're your two options, A or B, and I think the RBA has played their cards quite poorly. They got to the party late. They haven't really been aggressive enough in what they've done, which is why, despite moving interest rates up, we're still seeing inflation gain more momentum, and their expectation is for it to continue to do so. So,
8% by the end of the year.
Yeah.
They
so
say.
if you do so that's a further 10% increase on current price rate.
Yet our rate hikes have been nowhere near as aggressive as the US. Why would that be?
I think it's this softly approach. Oh, we'll just gently rein this in. And unfortunately, inflation is a nasty beast with fangs, as people are starting to discover. That once it gets momentum, it goes across everything and almost becomes a self-fulfilling prophecy. So, if you look at a really simple example of this, so let's take farming. So meat prices were higher because we've had a drought and various other structural issues within the farming community. So meat prices were already high. And then the cost of production, because if you think about it, there's diesel involved with farming, there's corn involved with feedlots, and so on and so forth. All those commodity prices have gone up, so it pushes the price of meat up higher, which means when you go to the supermarket, you then have to pay more for it, which means you need to earn more, which means as you're now earning more, you've now got more money to spend, so there's more capacity for that meat to be priced higher for you still to buy it, until that cash is taken out of the economy by higher interest rates, effectively, and that's how interest rates control inflation. It's called monetary policy. It's probably one of the more responsive ways of trying to deal with inflation, and it's one of those things. I think you can't make a threat. You've actually got to follow through when you manage an economy in that way, to say, look, we're thinking about raising interest rates. You go bang, and you've got to have a fairly strong opening gambit there to say, look, we're not messing around with this. We're going to rein it in, because it starts to then spiral. Because if your wage costs have gone up, your landlord knows you've earned more, so they'll put the rent up a little bit more, and then and the whole thing just expands outwards and becomes very difficult to. You can't put the pin in the balloon. It's like an overly inflated balloon, and you can't put the pin in the balloon so it'll pop. You've got to just slowly let the air out of it to get it back to normal. And if you go too hard, it is putting the pin in the balloon. It pops. The economy's in a recession. If you just gradually let the air out, you can rein it in. And the US, I think, have done an okay job of that, even though they've come out pretty hard.
Well telegraphed.
They've been extremely clear in what they're doing, whereas here in Australia we haven't been. So no, I think we've got further to move up in our inflation, and because our currency is relatively weak, especially versus the US dollar, I really don't envy you your US trip at Christmas. It's going to be pretty punchy when you're drinking a $25 Aussie beer, but good job you don't drink much. The reality is that we're going to start importing a lot of inflation, and with our weaker currency, because our interest rates haven't moved up as aggressively, say, as the US, to maintain some form of parity, it becomes a bigger problem for us here. And I think it's going to be here to stay, certainly until the central bank gets its act together. I think they've had one eye on the property market. We don't want to destabilise that because it's so important, and you can't build an economy out of one pillar.
Okay, so to wrap that around, AB, US, we saw 9.1% inflation reading at peak. We're now back down at sort of 7.7. If we look at the US in particular, specifically for a second, we're expecting inflation to slow down. Is that correct?
I think that's the general consensus. I mean, we've had one data point, and I think sometimes the biggest difficulty, again, you wouldn't want to be one for all the tea in China. The decisions you're making are real time based on historical data, and they don't have an impact for several months. It's a really difficult, and that's, I guess, why you've got, in some instances, pretty smart people in those roles. the PPI figure that's due out, I think, is going to be a better indicator as to where things are at. And if that's also softer, I think, yes, we have seen peak inflation. If that's not that soft, if it's stubbornly high, I don't think it's over yet. And we're also looking at energy prices that are reasonably stable right now, and they could potentially run higher into the back end of the year with geopolitics and everything else in that sort of space, and that might be a kick along to give us a little bit more of an inflationary problem again, going through the back end of the year and into the new year. But by and large, I think their strategy of hitting it hard has worked quite well. It's taken a bit of the wind out of the sails, and they can likely reap the reward of that, and they may well even avoid recession, which is, given how strong the job market is there, still is a realistic possibility. So it's been managed thus far pretty well.
So with that, if we're expecting that, we'd also expect slowing rate hikes from the US Fed. With that, what kind of investment opportunities would you see fit? Would you consider maybe tech in that example?
Yeah, I think high multiple companies where they've got a really high PE typically do better during times of lower inflation. Their future earnings are worth more. So in that respect, I think that's quite attractive. If you've got companies that carry substantial levels of debt, infrastructure companies, a good example of that, and rates start to come down, the cost of servicing that debt is reduced, which is good for the bottom line. But I think your staples typically, while people are coming to terms with the false dawn, is it genuinely is inflation coming down and things are going to not be as painful for us or not, and they still moderate their spending. There's a lag factor, if you will, between the economic data and the reality in someone's hip pocket. So you might have a couple of months before you start to see the consumer sort of getting the wallet out of their pocket a little bit more freely as well. So there's definitely a lag there, but I think staples, probably consumer staples, groceries, things like that should probably do quite well. And again, a lot of people are doing it tough because inflation's slowing down, it doesn't reduce the cost of living, and a lot of people are struggling to make ends meet. So I do believe that those areas that we've talked of previously, Dollar Tree, Ollie,
Ross stores,
the Ross stores, those sorts of discount type businesses are still really well positioned to capitalise on a bit of a shell shocked consumer, I think. Over here in Australia, different kettle of fish altogether, because I don't think we're at the end of it, and I think that the failure to move aggressively, quickly enough, and on a more sustained basis is going to be something that the RBA rue, because it's going to take them an awful lot longer to get inflation under control.
So if you're looking here in Australia, we're expecting inflation to increase, as the RBA made mention of, and for whatever reason, we're still doing only 25 basis points on a rate hike, despite having higher expectation inflations. What would you be looking for from an investment opportunity here locally?
Yeah, I'd be very, very careful. I think the strategy that we've talked of to a lot of the clients is that just keep the scoreboard ticking over, scoring singles. Don't be looking to shoot the lights out. So if there's an opportunity to sort of shoot for and bank a small but regular profit, they're the sorts of trades I would be looking at. Things like hold the strike has been quite handy in terms of one of our strategies for that. Buying rights where you can be in and out of a trade in a couple of weeks, and defined, I suppose, by being a little bit more of a volatile trade in the first instance to make it worthwhile doing that. They're the sort of areas I'd most likely be looking at, but it's very, very hard to have a really strong sector view when you've got an RBA that have been reluctant to sort of squeeze the trigger. And you don't know how they're going to go about doing that, because they've been really opaque with their commentary as well. And then if they're confronted with data that's really ugly in terms of runaway inflation still, do they have the spine and the ability to swallow their ego enough to go, right, we need to go a bit harder here, here's 50 basis points or 75 to get this under control? There'd be a lot of political pressure on that, given homeowners in particular. 66% of Australians are homeowners, and a good many of them have joined the market in the recent sort of bonanza. If you start moving rates really aggressively up, it's already getting prohibitively expensive for some people to service their debt, and that's a very real spectre. But the RBA's job isn't to support the property market; it's to ensure we've got a robust and I guess sound structural economy with inflation in particular under control, and it's not at the moment.
It's funny when you look at the economy here in Australia, and I just simply look at the comments that Phil Lowe made at his most recent statement, expecting higher inflation towards this year and then Q1 next year, and then potentially slowing. He also made mention of the fact, though, that he's expecting quite an uptick in unemployment. So I guess if they're hinting at the fact that they're a little bit behind the eight ball. They have to go pretty hard once it starts getting out of hand. You might even start to see the labour market struggle here more so than the US.
I think so. I mean, the labour market's been really quite robust in the US, and look, it's kind of helped that you've got an inflow of cheap labour climbing over the fence wall or gateway on the southern border. But the US economy has been pretty strong from a labour market perspective. Here in Australia, we've got a number of structural inefficiencies in our labour market, in that, if you look at people on benefit versus pre-pandemic levels, there are more people still receiving benefit than pre-pandemic, yet we've got an economy that's run way past that. So, our social security system is a little bit different, which maybe provides people, and I'll probably get some hate mail for saying this, but I think that the statistics and facts speak for themselves. If you've got a less warm blanket to hug, it's more inclined to push you into the job market. And given the fact that there's an absolute shortage of labour out there, yet you've got long-term unemployment and people that are remaining long-term unemployed still sitting there, you've got to have a bit of an overhaul, I think, of the welfare system and support network if you want to get that labour market running at the most efficient level it can be. And that's, if you are able to work, you probably should be.
Plenty of challenges right now. I think we're at that key point, really, aren't we?
Oh, absolutely. And I guess these are why these guys they've got their hands on the big controls that control the the ebb and flow of our economy. And let's hope they do a good job of it. And in some instances, as I say, it's hard to lay any criticism at Jerome Powell in the US. He's been exemplary in terms of the way that he's managed market expectations, and they got to the party late, but they've corrected that by going out hard and doing what needs to be done. And I go back to Philip Lowe. It's just been very opaque dialogue and not the definitive and decisive action that's required in order to rein inflation in. And that's why, despite having a number of interest rate rises, we still have rising inflation, and it hasn't peaked in Australia. Be interesting to see what his annual performance review looks like. If his boss, if he has one, sits down and says, okay, let's evaluate your year this year. Do you think you've done a good job?
Well, I wonder if he starts to bring inflation down, does he too take a pay cut?
Well, pretty well paid central bankers typically, although some of them have a career outside. I mean, Jerome Powell's had a very extraordinary career outside. I think, was it not Black? Where was he? Was it Boston? Was it Boston Consulting? I think he's kicked some pretty big goals in his professional career.
Interesting.
Prior to moving into that role, and maybe those business lenses that he's looked through have helped him with the way that he's managed the economy there. But it's chalk and cheese at the moment what's going on in the US versus here. And don't get me wrong, there are some big flaws in the US too. That absence of social security and the endemic levels of homelessness, for example, is terrible, and it really is. There's a huge imbalance of wealth there. It's possibly a subject for another type of podcast, but the reality is, I do think we've seen, very, very close to, if not we've had peak inflation in the US, and we're a long way from that here. And it's just down to the action of our central banks.
And all in all, the advice is don't try and hit a home run. No. Just keep the scoreboard ticking over, cheeky singles.
Keep the scoreboard ticking over, cheeky singles, nothing trying to hit the boundary, not the market for that. And I think those times will come as we see this market base out, and there'll be plenty of time for that. And that's why having your powder dry is key. Keep the scoreboard ticking over with some singles, keep yourself market fit, but don't be going out on a limb with anything that's outrageously risky or speculative. Just keep it straight, meat and potatoes.
Not like England last night in the T20 Cup final.
Look, after I think the weekend English sport had losing to Samoa in the Rugby League Cup, it was nice to come home with some form of silverware.
Yeah.
And let's see how they go in the Soccer World Cup, which isn't too far away.
Great bowling by Sam Curran too. He did a very good job.
There you go. See what you were doing last night.
Well, AB, thanks very much for your time today. Great insight, great information. Appreciate it.
Absolute pleasure anytime, Mitch. There you have it, guys. Make sure you give us a review and a rating, and we'll look forward to hosting you next week.